Tesla has to first prove that they can actually drive fully autonomously without a safety driver in the car, which they haven't done. And the first stock I bought in the portfolio was Spotify. I think that's up about 600% since then. Everybody knows about, and it was just sitting there. And if you looked at the financials, you could see these tailwinds coming. What I've seen over the course of the last 20 or 30 years is to find 10 baggers, you don't have to take massive risks like that. You can look at Netflix, Amazon, Apple, Microsoft. These are companies that either are 10 baggers over the last decade or very close, and they had very established businesses.
Welcome, everyone. We're going to be talking a lot about 10 baggers today. I am interviewing Travis from Asymmetric Investing YouTube channel. Travis, thank you for joining me.
Thank you for having me.
Yeah, so I think we have a lot in common. We like to take risks. We like big bets. So talk to me about, what is asymmetric investing?
So asymmetric investing is I have a YouTube channel, but I also have a newsletter where I'm doing kind of a little bit more written research. I've been writing for The Motley Fool, and actually started my own investing blog in 2005. That sounds like forever ago at this point. But I've been writing about investing for quite a long time. YouTube has been a phenomenal way to reach people with kind of my investment philosophy, talk about stocks that I'm interested in. But then on the newsletter, I have a asymmetric portfolio where I buy stocks once a month, and I'm really putting my research and kind of all the tools that I built over the last almost 30 years of investing to work and sort of putting my money where my mouth is. It's always a challenge, I think. We hear what analysts say, upgrades and downgrades, but they don't actually own the stocks that they talk about most of the time. So this is a way for, somebody in my position that doesn't have those same stringent rules to say, okay, I'm going to say positive things about this company, and then I'm going to actually buy it because I actually believe the things that I say. So that's sort of the philosophy around it. And all of this is about finding 10 baggers, finding asymmetric returns. The most you can lose with a stock is the amount of money that you put into it. But the upside is at least theoretically infinite. So let's try to find those companies. That's actually the best way to beat the market. So that's the frameworks that I've built the entire business, YouTube channel, and newsletter around.
Now, you talk about sometimes, you're looking at the disruptive technologies, disruptive businesses. Now, a lot of times, or sometimes with those kinds of technologies, there's not a lot of revenue going on yet. So do you look at those companies too?
It really depends. And I typically like to look at at an industry first. So I will start with where's an area that I want to be invested. So autonomous driving is a perfect example of that today. And then so I go, okay, this business could be 10 times bigger. Uber, Lyft, 10 times bigger business than taxis were. Autonomous driving, I think, could 10x that market even further. And then drill down and go, okay, what does the business models look like? What are the strategies that these companies are going to deploy? And I typically do not buy zero revenue companies. I have at least one in the portfolio now. But what I've seen over the course of the last 20 or 30 years is to find 10 baggers, you don't have to take massive risks like that. You can look at Netflix, Amazon, Apple, Microsoft. These are companies that either are 10 baggers over the last decade or very close, and they had very established businesses. So I try to learn from a lot of those things, the companies that were compounding revenue, expanding margins, and ultimately drove those returns to investors, because I think those are the things that are going to be replicable over the next 10, 20, 30 years. But it doesn't necessarily mean that you have to take these moonshots with companies that don't yet have any revenue, because a lot of times those are just a much higher likelihood of going to zero.
Mm-hmm. And the ones that you look at, do they have to be profitable?
No. But I want to see that there's something that I can point to that says they're doing the thing that they say they're going to do. So an example today would be Joby Aviation. I added that to the portfolio. I think it was starting in March. So very, very lucky timing as far as that one, because that's kind of gone crazy over the last couple of weeks. But, they're moving forward with their FAA certification. We're seeing their partnerships be lined up. We're seeing them actually.
Are they flying taxis?
So they're flying aircraft. They're not flying commercial operations yet. That will be coming either late this year, probably early next year in Dubai. That'll be the first place that they launch. So you're starting to see sort of those check marks that you want to see for a company. Now, that's one I'm not going to be all in on. That's going to be more of a small position that I'd be happy to let it grow into a larger position, but that would be more of a moonshot. That's not a company that I'm going to be putting, 10% of the portfolio into, like some of the companies that have at least grown into those bigger positions in the portfolio, because it is a little bit higher risk because we don't have that evidence that revenue, margins, net income is actually going to flow into the business yet. So I don't want to write off any of those companies, but I also don't want to overpay or over expect, some sort of disruption that we don't actually know is going to happen yet. So that's sort of it's an interesting balance, because I want to take risks, but I don't want to take too much risk. I talk about it being a VC portfolio in public markets, but you don't have to only play with penny stocks, for example. You can actually just stack a lot of advantages to your favor, and actually oftentimes buy companies that are kind of sitting right in front of your face. I mean, the first stock I bought in the portfolio was Spotify. I think that's up about 600% since then. That's a company that's been public for a long time that, everybody knows about. And it was just sitting there. And if you looked at the financials, you could see these tailwinds coming. And now they've kind of come to fruition, and the narrative around the stock has changed. And that's oftentimes where you get some of these 10x returns.
Now we have a lot of talk about the um, self-driving cars,
Mm-hmm.
robotaxis. So that's on the Tesla front. But I noticed you talked about
Mm-hmm.
Lyft in one of your videos. So I was wondering if you could share some of your thoughts on this trend and Lyft.
Yeah, I think the easy way to look at autonomous driving, if you're not really diving into the industry, is just to say, oh, Tesla must be a leader. But if you look at the data, even who has licenses, who has been driving vehicles in the state of California, Tesla has had a license for years to do fully autonomous driving and hasn't done any. They have put 0 miles on, while companies like Waymo, even Apple put on, tens of thousands of miles now. And then you could look at the data and you could say, okay, how many miles are they driving between each intervention? So you could sort of see the technology progress. And so that's sort of like those. The market is being proven out, right? The technology is being proven out. So now I'm not crazy getting into autonomous driving because Waymo's doing the thing. Uh, but then you start to look at, what is this business model going to look like in the future? How are we going to actually interact with autonomous vehicles? And if you just walk through a business model like Tesla's, do I believe that somebody's going to buy a $40,000 vehicle and then just let it go drive itself around for a couple hours at night to make a few dollars? I really question that. So what might this look like? What if autonomous technology is not owned by one company? What if it's dozens of companies? Now you have much more of an aggregator market like you have today with Uber and Lyft. So Uber, obviously the biggest player. I own both of those stocks in the asymmetric portfolio. But what's interesting with Lyft is they have a pretty clear strategy of what they're going to do in the future. They're saying, hey, we're going to be the aggregator of demand. We're going to partner with these autonomous driving companies who are going to be basically fleet operators. They bought a taxi company in Europe that actually isn't going to be interacting with individual drivers. It's going to be interacting with fleet owners who would theoretically own fleets of autonomous vehicles. And then they're just going to be connecting them to the riders. So the business model effectively is the same as it is today, but instead of individual drivers on one side, you have maybe a company that owns 10 autonomous vehicles. And then Lyft and Uber is doing some of these same things, can offer services, can say, you know what, we'll clean the vehicles for you. We'll keep them charged. We'll make sure the fleet is operating in the way that you would expect. That business model and buying that stock at 10, 11, 12 times earnings when they have a really, really good balance sheet, that's where it's sort of an unloved company. But that's the kind of company that, if you look, throughout history, typically the companies that are going to 10x in value go from being sort of overlooked and unloved to being, oh my gosh, this is obviously a great company and a great play. So if you get in early on those companies because you see the business models changing and them actually being in a much better position than I think a lot of people in the market, that's how you find those opportunities. So I think I just look at the way that the autonomous driving is going to play out very differently than people. I don't think it's going to be a winner take all market from a technology or a vehicle standpoint. I think we're going to have dozens and dozens of automakers who have autonomous technology, who can plug into these, companies like Uber, like Lyft. Waymo may even license their technology. They had a deal with Toyota. So then you look at who's going to be the winners. It's the aggregators of demand. It's the modular companies. I mean, Mobileye is another one that I'm interested in. That's a modular company. They're not going to make vehicles, but they're going to make chips, a sensor, and then license it to dozens of automakers. That's a potentially really good business there. So I just think I'm trying to look at these businesses and then understand what the business model looks like, because that's ultimately what's going to drive revenue and cash flow.
If Lyft is trading for, as you said, 10 times earnings, is it because investors are concerned that Tesla is going to crush them?
I think that's the common narrative. Yeah, absolutely.
And so, yes, Lyft and Uber, they have their apps,
Mhm.
and as you know from Warren Buffett, it's the network effect. The more people are on the app, the more drivers want to be on the app. But uh, Tesla is going to have, or they have their own app,
Mhm.
right? So you're not too concerned that the demand can migrate on Tesla's app.
Tesla has to first prove that they can actually drive fully autonomously without a safety driver in the car, which they haven't done. So that's the other piece.
What do you mean by a safety driver?
Well, what they're doing in Austin today has a safety driver in the car. They're sitting in the right hand side of the vehicle. They have a
Well, there's a safety driver
there's a
that's
safety
not holding the wheel.
there's a safety person in the car. Yep. Yep.
What's the point? Why not just have a driver then?
Because it doesn't look like there's a driver in the seat, but there's somebody that can stop the vehicle, that can the first videos that came out online, those first day of launch, it was the same guy that was sitting in almost every single one of those rides. Look, this is where, like, if you look at the data, Tesla has never actually shown that they are safe enough to be fully autonomous. They just haven't. Maybe they get there, but they haven't actually proven it.
So as of now,
Mhm.
Waymo has more data that shows Waymo is
Correct.
safer.
Yes. Yep.
Am I right?
And they're
Okay.
doing
Wow.
seven hundred
I did
thousand
not
rides a
know that.
week in the state of California. I mean, they're reaching scale really, really quickly.
Okay. So, changing topic. You talked about you used to write for Monthly Fool.
But
What was it like? You still
yeah, I
do?
still do some writing there. My videos end up on the Motley Fool. Yeah, sure.
What is it like to write for Monthly Fool? Are you like an employee, independent contractor? How does
Yeah,
it
I'm a
work?
contractor. Most of the people who are going to be writing the articles that people are going to see are contractors. Yeah.
Okay. And in terms of your YouTube channel, how long have you had it, and what made you wanna go that route?
Just over 3 years, just past 3 years. And I wanted to, I just tested kind of making video. We were, I guess towards the end of the pandemic at that point. But it seemed like that was kind of an area that there was an opportunity to maybe have a little bit different discussion and build something kind of on my own with asymmetric investing. I actually started covering a little bit more crypto type stuff. I was really interested in the disruption that was potentially happening in that space, and eventually, just decided I need to focus on it. It's very difficult to talk about crypto and stocks in the same area. So I, at some point, had to decide I need to focus on only stocks and kind of leave the crypto stuff behind. I do own Coinbase, so I talk about that every once in a while. But yeah, and once you kind of get that ball rolling, it's really fun to see the channel grow. And then that was obviously a great piece of the newsletter as well, because that's a great way to connect to more and more people who are interested in reading what I'm writing on asymmetric investing.
Uh, I don't remember if you answered this, but you've been doing YouTube for like 3 years, right? So you kind of missed that 2020
I did,
craze,
yes.
where when it was so much easier to grow the
Yeah.
YouTube channel.
Yeah, I should have done a lot of these
Yeah.
things 2 years earlier, but life gets in the way.
Yeah. Are there any other stocks or industries that you like?
Yeah.
Because I noticed you talked about hims and hers, so you probably like the telehealth too. But I will let you take
Well,
over.
telehealth is interesting. I did a video recently comparing Hims and Hers and Teladoc. And so this is
Mm-hmm.
again where I think, I talk a lot about strategies and concepts. The smiling curve is a concept that is you can kind of fit across industries, especially in the digital economy, where it essentially comes down to who are people choosing to interact with. And Hims and Hers, you can look at their growth in their subscriber numbers. They have a little over 2 million subscribers today, and then you look at Teladoc, and they've got, I think it's 100 million members. But then you look at their revenue per user, and Teladoc is at like $1.25 a month, and Hims and Hers is at like $85. I'm going to get these numbers directionally correct. Uh, and what's different there? Individuals are choosing to interact with Hims and Hers, whereas Teladoc is typically bought through a corporate insurance policy. I mean, I may have access to Teladoc today. I have no idea, through our insurance policy, but I don't use it because it's not something that I have chosen to
But
pay
the, but
for.
then but then if you had access to it through your insurance, would you be counted in that 100
Yes,
million
yes.
users?
Yeah.
Okay.
So it doesn't say we have 100 million people interacting with us. It's just not every company is the same, and not every company can be looked at the same way. And so that's an example of, am I interested in? I'm interested in disruption of healthcare. I think that at the end of the day, especially in the U.S., this is such a messed up system that anyone.
I mean, I can't tell you. Like, I would rather chop my leg off than to see a doctor. I'm telling you.
So anyone that's looking at this industry differently, I'm willing to listen. And when I first covered Hims and Hers, it was not the rocket stock that it is today. I think it was trading for about $16 a share, um, but it was growing like crazy, and they were clearly looking at things very differently. They were not taking insurance.
Mm-hmm.
The platform that they were building looked a lot more like, you know, Netflix than like United Health, or some of these other direct. If you go to like the direct to consumer Novo Care site, it looks a little bit like Sears making a website in 1998. It's just, I'm sorry, it's not going to work. Uh, so
Mm-hmm.
so they're clearly doing something differently, and then you start listening to the conference calls, and Andrew Dudum and the leadership team there clearly has a vision that is much bigger than what they currently have, and that's compelling. That's where you get, I talk about, on asymmetric investing, about the great thing about investing this way is I don't have to be right 100% of the time. If I'm looking for stocks that are going to 10x in value, and 20% of them go to zero, that's okay, because if 20% of them 10x, then I've crushed the market. So it is sort of a strange way to invest if you're looking for every single stock to be a winner. But you don't have to be in these cases if the upside is, really, really big. In the case of Hims and Hers, you're talking about a business that, I mean, pharmaceuticals alone is a $400 billion business in the U.S. I think. I mean, that's just the U.S. This is a stock that could potentially 100x, 1,000x over the next 20 years if they do it right, and if they get disruption right. I'm not saying that that's going to 100% be the case, but if that's the vision, then taking risks on some of these companies that, maybe we don't know all the answers. Maybe there are some gray areas that they're in that aren't super comfortable. That can be a really great way to find companies, because that uncertainty that the market sees is actually an opportunity for you as an investor, because the market doesn't like uncertainty, but you should kind of lean into it as somebody looking for, big upside in stocks.
Companies like Hims and Hers or like Oscar
Mm-hmm.
Health, it's interesting because the retail has got it right. The retail, I'll beat Wall
Yeah.
Street to
Yeah.
these names, and retail used to be this dumb
Right.
money, AMC, but now it's pretty impressive how retail investors are taking. The retail people have advantages, built-in
Mm-hmm.
advantages, but they weren't taking advantage of those advantages, and I feel like now they are.
Yeah, and let's just can we just talk about a couple of those advantages, because these are the things I'm trying to lean into with asymmetric investing. Structurally, most of Wall Street can't be long-term investors. So,
No, it's quarter to quarter.
you and I, we can say, okay, I see this happening in 10 years maybe. And that's what I'm
Hmm.
investing is in that vision 10 years from now. So you can be a long-term investor as an individual investor. If you're running a hedge
Hmm.
fund, if you're running even a mutual fund, you've got to answer quarter to quarter, at the longest maybe a year. And if you start underperforming the market, people are going to get upset and start pulling their money. We can also, stay invested. That's another way to beat the market. Is things are going to go up and down. But Hims and Hers is a perfect example of, there were a lot of investors, retail investors, who were buying that when it first came public because they saw the vision, and then the stock dropped like a rock, like a lot of things did in 2022. And people who knew the business and were comfortable with what they were doing doubled down. I did that with Coinbase. So you can have that, stay long term, stay invested, live further out on the risk curve. Again, a lot of institutional investors are not comfortable taking risks in some of these companies, whether it's Hims and Hers or Joby Aviation, that maybe you don't necessarily have all the answers. I buy compounders. We talked about a few of those things.
Hmm.
A couple of other things that I just want to note: over indexing on founders. That's another thing that, as I think we see this with Hims and Hers. I think those of us who listen on a regular basis, Andrew Dudum is a pretty impressive CEO, and I think is figuring it out. Vlad at Robinhood is another person, is figuring out how to be a public CEO sort of before our eyes. You know what? Mark Zuckerberg went through the same process 15 years ago when Meta went public. So, and then we can embrace that uncertainty and just ride this out. So I think that has put retail in a pretty good advantage, and having some big wins like the Teslas of the world, like the Palantirs of the world, that sort of gives, I think, the retail investor confidence that, hey, you know what? I can execute this long term vision and beat Wall Street. And Wall Street is kind of flummoxed by it, I think, still to this day. There's a lot of institutional money that is short Hims and Hers because they just don't see it. But I go back to, I own shares if you want to talk about investing mistakes and things that I've learned from. I own shares of Chipotle in 2007. Um, Dan Loeb was short Chipotle either in 2007 or 2008
Hmm.
because, he was running these numbers and, well, meat prices are going up, blah, 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 blah. And what he missed was the simple story. People love to go to Chipotle, and the lines were long, and it was a phenomenal business. And they went through some ups and downs, but again, another compounder that the simple story that retail understood was correct. And the people who are trying to model some of these things, this is one of the reasons I don't do models, is the only thing we know about a model is it's wrong. It's just a matter of where is it wrong, and in what direction and what magnitude. And so, I think the simple story that retail often gets right is usually right. I don't own every single company that retail loves right now. Um, Oscar's one I just can't wrap my head around exactly what gives them advantage, but it is one that I listen to their conference calls. I'm trying to learn more so that, can I figure out what, yeah, a lot of people right now really like about that stock. But you're right, it is sort of a paradigm shift over 10, 20 years ago.
Yeah. Do you have any final thoughts that you would like to share, and also tell people how they can find you?
Yeah, I think the biggest thing for investors, if you're watching this, whether you're new, whether you're experienced, is just absorb as much information as you possibly can. Whether it's interviews like this. I think there's some phenomenal research out there. That's one of the things that's really changed over the last 10, 15 years, is that the research that was, what you would call it, institutional grade from analysts, that's now coming from, niche sources like myself. So if you want to learn more from me, Asymmetric Investing is the YouTube channel. You can also find me online, asymmetric-investing.com. Got free side of the newsletter, and then the premium side has the asymmetric portfolio. We're doing pretty well against the market, just past 105% returns on that in a little less than 2.5 years. So love to have you there, and thanks for having me.
Yeah, thank you for doing this.
Appreciate it.